Hello, and welcome back to episode 4. I can't believe we're on episode 4 already of Property School. Today we are going to look at property jargon. So all those words that we might hear people talking about in the property industry that we're thinking, what does that actually mean? We looked at one of these kind of last week, which was all about mortgages, like what actually is a mortgage. So you can catch up on that on any of the other episodes on YouTube, IGTV, which is where you can watch them, or you can listen to them wherever you get your podcasts. So just very briefly introducing Property School and myself. So I'm Lexie. I always say my whole life revolves around property. I'm a property finder, I'm a developer, I'm an investment landlord. So fingers in many pies, but pies to do with property. Fingers in many property bits, I guess. And Property School is where I'm kind of bringing you everything that I wish we were taught in school and everything that I wish I knew 10 years ago before I started out on my own property journey, as well as everything that I'm still learning on my property journey now. Because I always think that, you never know everything, do you? Of course you don't. There's always something else to learn. So there you go. And don't forget, if this is the first time that you've watched an episode of Property School, I quiz you at the end of each episode. So make sure you are listening very carefully. I might give you a little clue throughout the episode, and then I reveal the answer in next week's episode. So on that note, let's look at last week's answer to last week's quiz. Like I said before, it was all about mortgages last week. So the question was from last week, what do the following stand for? We had 3 acronyms. We had LTV, ERC, and SVR. They were all to do with mortgages. So LTV is the loan to value, ERC is an early repayment charge, and SVR is standard variable rate. So well done. If you've got any of those, or all 3 of them, very well done. So keep listening throughout this episode and I will give you the quiz for this week. So I'm going to try and split this up into sections. We're talking about property jargon. So basically, I'm just going to fire at you loads of words to do with property. So make sure you save this, share it with anyone that you might feel would find it useful. And we'll start with, I know I've just gone through some acronyms that we looked at last week in mortgages, but let's start with some common acronyms. Like I said, I covered some of these in our mortgage episode last week, but it's a good reminder, isn't it? I feel like the more you hear something, the more it's going into your head, the more you'll know about it when the time comes. So SDLT, stamp duty land tax. So that basically needs to be paid if you buy a property or you're buying land over a certain price. I'm going to do a whole episode on SDLT, stamp duty land tax, because it's kind of complicated. It's basically it's the percentage of the property price, but it has different thresholds depending on the price of the property. So it's a little complicated. Trick is to just go online. You can do a stamp duty land tax calculator, nice and easy, but I always like to know why I'm doing something. So I will go through a whole episode on stamp duty land tax. BTL is buy to let. That's where you're buying a property to let it out. We're going to go through buy to let mortgages at some point as well. HMO, that's a house in multiple occupations. So basically people that aren't from the same family living at a property. SA, so Sierra Alpha, is short-term accommodation. So that's like your Airbnbs or properties that are rented out on a short let, which is normally considered under 6 months. But of course, when we're thinking about Airbnb, it's nightly, isn't it? It's almost like hotel accommodation sort of thing. So that's SA. And I'll go through all these different strategies in another one. So today we're just doing property jargon. BRRR, that is buy, refurbish, refinance, rent out. Again, I could do a whole episode on that, but today it's just about the jargon. FTB is first time buyer. You might hear that quite a lot if you are a first time buyer getting into a property. AIP, that's an agreement in principle. So basically a lender saying what you can technically borrow based on your situation, and that they are happy to lend you that amount. So that's your AIP, agreement in principle. You need one of those for getting a mortgage. It's kind of the first step of getting a mortgage, and then when you book in viewings, you can say, I've got my agreement in principle up to X amount. ERC, that's early redemption charge or early repayment charge. We spoke about that and what that is in the mortgage episode last week. So go and have a watch of that if you want to find out more about mortgages. It's basically a fee or penalty that you have to pay for repaying off your mortgage early or moving to a different provider. So some mortgages will have like a 2-year fixed rate, for example. If you break it before that, or you want to move before that, or you repay stuff off, then they're going to charge you. So I talked about that in last week's episode, doing a lot of plugging for last week's episode on mortgages, aren't we? EPC, that's an energy performance certificate. So it basically details the efficiency of a property's energy usage, and it ranks it between A to G, with A being the most efficient, G being the least efficient, and it basically aims to give an estimation of the energy costs of that property. It's a legal requirement for the sale of a property or a rental of a property now. It didn't used to be, but it is now. It's based on things like double glazing, the heating system that's in the property. Basically the more efficient it is, then it will be up at A to G. So A through to G. That's your EPC Energy Performance Certificate. ROI is the return on investment. So when we go through and move on into property investing, we'll speak a lot about ROI. So it's basically the amount that you get back versus what you put in the first place. So some developers and investors will base their whether they're going to, whether they think it's a good deal on the return on investment, or they might base it on the percentage of this next thing, which is called GDV. So GDV is the gross development value. So that's basically what the property is worth on the market after all the works have been completed. So they have two kind of property investing terms that we'll look at further down the line in another episode. AST, that's an assured short hold tenancy. So that's the most common type of rental tenancy agreement that's kind of out there as a private let. So that means it's let by an individual, not a company or something, and it's under £100,000 per year. When I go through the renting process in another video, we'll talk about that. RPI is the Retail Price Index. So that's a measurement of kind of consumer inflation. It's produced by the Office of National Statistics, and it basically measures the prices that are rising. Sometimes it's kind of put into a long-term tenancy agreement, if I'm kind of relating it to property, for further years. So to give you an example, i.e., someone's doing a 2-year contract, the agent or the landlord might come back and say, that's fine, you can do a 2-year contract. It's either going to be fixed at the same price, or they're going to say, particularly if you try and offer lower, they might go, okay, we'll accept that lesser price for the first year, but in the second year, we want an RPI increase in line with RPI. Now, for my clients, I always put in something that's like a minimum of 2% or a maximum of 5%. So if the RPI shot up to like 7%, the maximum they could do is 5%. So again, when we talk about tenancy agreements and rentals, we can go into that a little bit more. But yeah, that's RPI. ISA, or an ISA, this is probably more commonly known as, is an individual savings account. So you might already have one of these. It's basically interest that is paid into that account is free from tax, and you can save a set amount in an ISA every year. LTV, we learned this last week in our mortgages episode, loan to value. So it's a loan to value mortgage. So for example, if you say you put down a 10% deposit, the loan to value, i.e. the money that you're borrowing, is 90% of the purchase price. So that's LTV, loan to value. There you go. Right, there's some acronyms. Anyway, this is just the beginning of this video. We've got so much to get through. And let's start with some kind of basics in property. A landlord. So a landlord is someone who is renting out their property to a tenant. That's another word that we could look at. So the tenant is basically someone that is renting that property and living in it. Vendor is someone who is selling their property. So if you're talking about sales, you're talking about the vendor of the property, the person who's selling it. If you're talking about sales, it's the landlord who is renting it. We talked about tenants there. Utilities, they basically are services. They're the services that go into a property, such as your water, your electricity, your gas, your broadband. Part of utilities, although I guess it's not actually a utility, I always think about council tax. That's obviously a monthly payment that you're going to have to pay as well. So all those things that are on top of your mortgage or on top of the rental price usually. Sometimes you do find that your bills are included in a rental property. Normally they're on top. So something else to bear in mind when you're thinking about monthly payments. Let's look at some property types now. So the word detached, if you're thinking about a detached property or talking about a detached property, that's normally a house that stands alone on its own. It's got no walls that are shared with any other properties. Semi-detached, you can probably guess, is one wall that is shared with another property. A terraced property means that both walls are shared either side, so it's like a long terrace of houses. And an end of terrace, I guess, is kind of semi-detached, isn't it? Because it'd be at the end of that terrace. There's nothing on one side of it, but you've got a whole row of terraces on the other side. So it's kind of joined by one wall. A duplex. Now, a duplex is normally a property that is split over two levels. So it wouldn't normally be a house. You wouldn't normally call a house a duplex, I guess. It would be a flat that, if you think about like a period conversion property, so that would have been a house. You've maybe got a... it's been converted into two flats. You might have a lower ground floor and a ground floor that belong to one flat. It's split over two floors, therefore it's like a duplex flat. And then moving on from that, it's a triplex, obviously split over three floors. So if people start talking about duplexes, triplexes, that's normally what they're talking about. And then the complete opposite is a bungalow. So a bungalow, I live in a bungalow right now. I've sat in a bungalow right now. A bungalow is one story. It can be detached. I guess it could be semi-detached. Sometimes you find semi-detached bungalows, but yeah, it's over just the one ground floor. It's a little house just on a ground floor. A listed building. So these are set in different grades. You might hear people talking about it's grade 1 listed or it's grade 2 listed. It's basically a building which has special interest. It's normally quite an old building, and as such it has preservation orders on it, so it can be like really difficult to alter it, difficult to get planning. It could be difficult to extend it without permission. Permission usually comes from the local council, like it would with any planning permission. But yeah, they can be a little bit tricky, particularly if you were, for example, if you were you probably wouldn't be able to knock down completely a grade 2 or grade 1 listed property. You just wouldn't be able to do it because it has kind of historical interest. Freehold, so that's owning a property and the land that it sits on outright, or just land outright. So that's most houses. If you think of share of freehold, so mostly I would say it could be like period conversion flats. It could be flats that are in a building, but I'd say majority are going to be like period conversion flats if they're share of freehold. So that's basically flats in a building that share that freehold of land. So the freehold of land is the land that it sits on. You would each own your individual flat, but there's not one freeholder that owns that bit of land. It doesn't belong to one person. It's split between you. So therefore, you make decisions together. You look after the maintenance of the building and the grounds. You look after insurances. All together. And then a leasehold normally is going to be flats. It can be flats that are in period conversions if there's one freeholder. So with a leasehold property, there is that one freeholder who owns it. They may not even live there, by the way. They may not live in the development. They just own that freehold of land, and they sell the flats on a lease. Which is usually somewhere between 90 years and 999 years. So you still own the flat, but it's only for that amount of time. And if it gets to the end of that time, when you own the property, then you need to extend the lease, which can be quite expensive. So anything under 60 years, if it's got a lease of less than 60 years, is really difficult to mortgage, and it can be really expensive. It would require you to kind of extend the lease, which can be quite pricey. So something to think about if you're buying. Normally they're cheap properties, though. That's the thing. Also with a leasehold property, you normally pay an annual fee, which is called a ground rent, and that is paid to the freeholder by the leaseholders. That's usually on average kind of £50 to £200 per month, that kind of thing. But it can really, really vary. So think about that as a ground rent. There's also something called a service charge. I don't know if I've mentioned this later, but whilst it's on my mind, I thought I would talk to you about it. So a service charge is basically to look after the property. Sometimes you would pay a service charge annually, and it's a pot of money that's just sat there, or it might be on an ad hoc basis, which means that if something happens in the property, you pay it as and when, like ad hocly. So moving on to some buying terms now that we've covered some of those terms. So if you're thinking of buying a property, these are some things that you might come across and think, oh, what does that mean? Well, hopefully this answers your question. So ground rent, that is the annual fee paid by a leaseholder to a freeholder. Oh, here we go. I did mention service charge. I knew I did. So the service charge covers, running costs of the building. It's usually paid by leaseholders or share of freeholders. So things like insurance, maintenance. Some have it as like a sinking fund. That was the word that I was thinking of just a minute ago. So it's a certain amount that is paid annually. Or monthly, I guess some people could have it monthly, and then some have it like on that ad hoc basis, so it's paid as and when it's needed. So just to cover those again, why not? Then we've got shared ownership, so that's the option to buy a share of a property. So if you can't maybe afford to buy the whole property, then you can buy a share of it. So normally a share would be kind of 25% to 75%. It varies a lot, depends on your circumstances, on what they're offering on that development. And it can be from various sources. It could be that you are like sharing it with a housing association or a developer that's doing a new development, and they're offering that on it as well. And then you pay like an affordable rent on the remaining share that you don't own. So it's quite a nice way to like get into property for sure. If you don't, if you maybe don't have a massive deposit, or you would struggle with paying like a big mortgage on it, so that could be a way to start. And it's often offered on a lot of like modern developments. So probate, that is when the owner of a property has passed away and they leave that property in a will to normally a family member, and then maybe that family member is looking to sell it. That's often when you find like, oh, property is going through probate. It's a probate property. So probate proves that the will is valid, but it could take a very long time. I would say you're probably looking like 3 months, 6 months. It could take longer if it drags out, and a property can't exchange until probate is granted. So often they're very, very old properties. I've been to see so many probate properties. I'm quite interested in them because they're not for everyone. If you want to move into something very quickly, if you want a quick deal, they're probably not the way forward, because you've got to wait such a long time for probate to kind of be approved. Another word that you might hear is exchange. So this is when basically you've signed contracts for the intention to transfer the ownership of a property. So you're legally bound by the terms that have been agreed. Normally the deposit is paid here, or certainly like 10% of the deposit is paid here. If you maybe if you've got like a buy-to-let mortgage where it's 25%, you'd probably pay 10% of it here, and then the rest of the money's on completion. And the important thing about paying that money is that if you then pull out of the deal, then you lose that money. You kind of forfeit it. So that's something to think about when you exchange, and then you move on to the next stage. Talking about exchange, sorry, just going back to that very quickly. It can take days, it can take weeks between exchange and completion, and completion is that next step that happens. So completion is when the property is legally yours and you can actually move in. Yay! That's the bit that we're waiting for. The deposit, that is money that you put down to secure a property, whether you're renting or buying. So it's a term that can come across if you're looking to rent or if you're looking to buy. You need to show that you're basically serious about taking that property, buying it, renting it, and you're prepared to take on the property. Renting is usually, when you talk about deposits for renting, it's usually 1 week's rent as a holding deposit whilst you go through a process called referencing. We'll go through this when I talk about the actual process of renting, and then that 1 week holding deposit is deducted from the first month's rent. Then a 5-week damages deposit, which is the big deposit, which is held with one of the 3 approved tenancy deposit schemes, which you can hear more about in my How Not to Be Scammed video. Now, that was, which episode was that? That might have been episode 1, actually. But you can find it wherever you're listening to this or watching this. You'll be able to find How Not to Be Scammed by a Landlord. And then we talk about those deposit schemes there. Chain. So a chain is basically, most people are going to need to sell their current house to be able to afford their new home. Think of it like links in a chain. Like if everybody had something to sell, they're then relying on a buyer there to buy that property, and that buyer is probably selling their property and they're relying on someone else to buy their property. So it becomes a chain, and if one of those links of the chain kind of falls through, then it delays that whole process, and the whole chain could absolutely fall apart. So you're really relying on other people, and being chain free in a situation. So like if you're a first time buyer or you don't have another property to sell, That's a massive advantage to you when putting in an offer, because, you know, if you're putting in an offer it's chain free, it's very likely that that's going to go through because you're not relying on someone else. Equity. So this is a big one, equity. And remember this, okay? I'm just saying that, just thinking about what's coming up at the end of the episode. So equity is basically the value of a property that you own without a mortgage or a loan against it. So things, if you have equity in a property, that could come from the deposit amount that you've put into the property, the mortgage amount that you've already paid off on the property, and the increase in value of the property and what it kind of gains over time. So that's equity. Now, equity is something that people talk about a lot in property, and it didn't make sense to me for a very long time. So hopefully that makes a little bit of sense to you. Fingers crossed. And remember that word, equity. Giving you a little clue there. Gazumping. So this is something that a lot of people come across. There was a whole trend on gazumping back in the 90s. It's not very nice, but it became a thing to do. So gazumping is basically an offer that is agreed in principle by the seller, but then the seller receives another offer which is higher from a different party, and then they actually decide to go with that offer. So those people have been gazumped. Basically someone has come in over the price that they've had agreed, and then they lose the property, and then it could end up in a bidding war because they could come back and gazump the other people. It's not something you really want to get into, but unfortunately it does happen. And then there's a word which I'd never, ever heard used, but apparently it's a word. It's called Gazundering. Now, honestly, no one uses this word, but I thought I'd throw it in there because it's just quite funny. It's the opposite of gazumping, really. You might hear it being referred to as a knock. So basically, the buyer makes an offer that is agreed by the seller, but then they knock the price before exchange. It's naughty. It's naughty to do it, but it could be like a change in the value of property that's gone down. So they then go, actually, we're going to decrease our offer to this before exchange. So it's an annoying place to be in for the seller, of course, but that is technically gazundering. Yeah, I know, fun fact, or not, like knocking. So a bridging loan. Now we're going to talk more about this when we come to other loans. So we did the mortgage episode. We're going to talk about investing loans, so buy-to-lets, and one of them will be a bridging loan. So bridging loan is basically short-term access to money. It's a temporary loan to buy a property. Often it's normally always a very high interest rate, so you're paying a lot back on it. And I'll talk about this, like I said, in another video in more depth. And hopefully, fingers crossed, I'm trying to chase up a mortgage broker, but he just deals with people that invest. So he can tell us a lot about mortgages like buy-to-lets, bridging loans, development finance, that kind of thing. Let's go through some legal or process terms next. Like I said, I was going to try and group all of these, so hopefully they're making sense. So we've got a survey. So a survey is the report on the condition of a property when you're buying it. It's usually done by a building surveyor, which is instructed by the buyer or the end user. And they kind of, I guess, hope that they find something to reduce the price. That's that kind of survey that's provided by the buyer or end user. Or it would be provided, I guess, because this happens all the time anyway, mortgage, you get a mortgage survey. So that's instructed by the lender, so the person that you're borrowing money off, to check that they're actually lending on a sound property and that it's been priced at the right price, that they're not, lending money on something that actually isn't worth that amount. So, and that will always be undertaken by whoever the lender is. Land Registry, so this is a government department that looks after the ownership of land and the changes in ownership of land. So, for example, when you buy a property, then your name will go on that property as you've bought it on Land Registry. Then we'll look at estate agent terms. So these, if you're an estate agent or looking to get into agency, or you're speaking to a lot of estate agents, these are some of the terms they might use or are related to estate agency. So one is sole agent. That means one agent is marketing, or one estate agency is marketing a property exclusively. Sometimes, or more often, this will be almost like a little trial. So the vendor will be like, okay, this property can go on with you for sole agent for 3 weeks and see how you get on. If you don't sell it in 3 weeks, then basically I'm going to put it on. It could be rented or it could be sold, whatever. It could be the landlord, it could be the vendor. But yeah, if it hasn't been rented or sold within that 3 weeks of sole agency, then they go, okay, I'm going to put it out multi-agent, which is basically where they will instruct other agents to list it as well. So you're kind of, if you're a sole agent, depending how long you've got that exclusivity for, it's normally about 3 weeks as like almost like a little trial. You really want to kind of get it done and get it sold in that time for your buyer or for the vendor or for the landlord. Open house. So we don't have a lot of these in the UK, but they're definitely becoming more popular. So an open house is basically if a property is proving, super popular, loads of people want to come and look at it, then the agent runs something called an open house for, it's maybe like on a set day or it's between a set time, and they get as many house hunters through the door, like in back-to-back viewings as possible. And it will usually be inundated with offers on that day or the next day. So if you do go to an open house or in general, you kind of want to act quite quickly on things as well. Guarantor. So a guarantor is someone responsible for paying if you fail to pay either your mortgage or your rent. You can get something called a guarantor mortgage. If you're renting as like a student or something, then you would need a guarantor because you wouldn't be earning enough to pass referencing, which is usually 3 times the amount. You'd need to earn 3 times the amount of rent that you'd be paying. So people like that would have a guarantor. We'll talk about that in the rental process in another video. Usually need if you don't pass referencing or you don't earn enough to cover the rent or repayments on your mortgages. And then some property investing terms, which we'll go through when we move kind of more into property investing, which I will come to at some point in many episodes. So we've got the word yield. That's basically the income generated from the annual rent of a property as a percentage of the purchase price. So yield, if we were doing it as a calculation, it's basically annual rent divided by purchase price times 100. Then you get that percentage of the yield of the property. Capital appreciation or capital growth, it's sometimes called as well. That's basically the difference between the purchase price of the property and the price that it's sold for. So ideally, it's the value of the property goes up over time. That's why people buy, like my strategy in London is to buy a property that will hopefully go up in value and appreciate in value. And so your strategy is basically kind of capital appreciation or capital growth because fingers crossed, it's going to be worth a lot more in years' time. But in London, you don't get a very high yield. Like I would say most of my properties yield about 3.5%, whereas going up north, a lot of properties yield maybe 7 to 10%, which is a better return on the money that you've put in, but they might not appreciate in value as much over time. So again, we'll talk about those in more depth in another episode. Oh, there you go. And listen to that. There's the bell for this episode. And we know what that means, don't we? That means that it's this week's question time. So every week I give you a question about what we've just talked about. So we were talking about property jargon. You know what's coming, don't you? I'm going to ask you the meaning of one of the words that we have just covered. And I did point it out. I tried to give you a little clue. So my question this week is, what does equity mean? The word equity. Have a think, and I will give you the answer in next week's episode. So there you go. You're up to speed now on some property jargon. I hope I covered quite a lot in that. I feel like I covered quite a lot. I need to go have some water now. Make sure you do save this if you found that useful. You want to come back to anything or share it with anyone who you think, oh yeah, so-and-so might find that really useful. They're about to buy or they're about to rent. Like you've got some really good little words in there that you can pick up on and know what they mean. You can catch all of these episodes of Property School on video on IGTV or on YouTube, or you can listen to them wherever you get your podcasts. So please go and subscribe if you're loving this, and don't forget to save or share with other people. And I'll see you next week. Class dismissed.